Don't put all your eggs in one basket. This age-old saying holds a lot of wisdom, especially when it comes to investing. The power of diversification cannot be overstated. In the world of investing, diversification is key. It's a strategy that can help you navigate the unpredictable nature of financial markets. It's like having a variety of tools in your toolbox. Each tool has its own purpose and function. You wouldn't use a hammer to fix everything, right? Similarly, you shouldn't rely on a single type of investment. Diversification is about spreading your investments across different assets. This means not putting all your money into one type of investment. Think stocks, bonds, real estate, and more. Each of these asset classes behaves differently and can provide unique benefits. This strategy helps reduce risk by balancing potential losses with potential gains. If one investment goes down, others can cushion the fall. This way, your overall portfolio remains more stable. Imagine putting all your money into one stock. The risk is enormous because your financial future hinges on the performance of a single company. If that company faces tough times, you could lose big. Your entire investment could be at risk. But if you've diversified, the impact is lessened. The poor performance of one investment can be offset by the better performance of others. Diversification is about managing risk and protecting your hard-earned money. It's a way to ensure that you don't lose everything if one investment fails. It's a fundamental principle for any investor, big or small. Whether you're just starting out or have been investing for years, diversification should always be part of your strategy. Risk reduction, your financial safety net. Risk is inherent in investing. The market goes up and down. It's unpredictable. Diversification acts as a safety net. By spreading your investments, you're less exposed to the ups and downs of any single asset. Think of it like this. You wouldn't want all your money invested in a single company, right? What if something happened to that company? Diversifying your portfolio reduces the impact of any one investment on your overall wealth. It helps you weather market storms and come out stronger. The growth potential, diversification and returns. Diversification isn't just about reducing risk, it can also enhance returns. Different asset classes perform differently over time. When one asset class is down, another might be up. This balance can lead to smoother, more consistent returns over the long run. Imagine one year tech stocks are soaring, the next year it's real estate. A diversified portfolio captures gains from different sectors, maximizing your growth potential. Remember, diversification helps you navigate market cycles and capitalize on growth opportunities across various assets. Section 5, Asset Allocation, Finding the Right Mix for You. Asset allocation is crucial for diversification. It helps spread your investments across various asset classes, reducing the risk of significant losses. It's about finding the right mix of assets that align with your risk tolerance and investment goals. This means understanding how much risk you are willing to take and what you aim to achieve with your investments. A common approach is the Rule of 100. This rule is a simple guideline to help you determine the proportion of your portfolio that should be allocated to stocks versus bonds. Subtract your age from 100, and the result is the percentage you allocate to stocks. For instance, if you are 40 years old, you would allocate 60% to stocks. The rest goes into bonds. Bonds are generally considered safer investments and can provide a steady income stream. For example, a 30-year-old would have 70% in stocks and 30% in bonds. This mix aims to balance growth potential with risk management. This rule provides a starting point, but you can adjust based on your circumstances. Factors such as changes in your financial situation, market conditions, and personal preferences should be considered. Remember, there's no one-size-fits-all approach to asset allocation. Each investor's situation is unique, and your strategy should reflect your individual needs and goals. It's about finding the right balance for your individual needs and goals. Regularly reviewing and adjusting your asset allocation can help ensure that your investment strategy remains aligned with your objectives. Section 6. Navigating different asset classes, stocks, bonds, and beyond. Stocks represent ownership in companies. They offer higher potential returns but also come with higher risk. Bonds are debt securities. They typically offer lower returns than stocks but are less volatile. Real estate includes properties like homes, commercial buildings, and land. It can provide income and appreciation potential. Commodities are raw materials like oil, gold, and agricultural products. Their prices can fluctuate based on supply and demand. Diversifying across different asset classes helps you capture gains from various sectors of the economy, reducing your overall risk. Section 7, Diversification in Action, Real-World Examples. Let's say you have $100,000 to invest. Here's how a diversified portfolio might look. $60,000 invested in a mix of large cap, mid cap, and small cap stocks across different sectors like technology, healthcare, and energy. $30,000 invested in a diversified bond fund that includes government, corporate, and municipal bonds. $10,000 invested in a rental property or a real estate investment trust, REIT. This portfolio spreads risk across different asset classes, reducing the impact of any one investment on the overall portfolio.
Section 8. My personal diversification journey lessons learned. In this section, I want to share some of the most valuable lessons I've learned over the years about diversification. I've always been a big believer in diversification. It's not just a buzzword, it's a fundamental principle that has guided my investment decisions. It's a cornerstone of my investment philosophy. Early in my career, I was eager to make quick gains and thought I could outsmart the market. I made the mistake of concentrating my investments in a few stocks. I thought I had picked winners, but I was wrong. When those stocks performed poorly, it was a harsh wake-up call. My portfolio took a hit. The losses were significant, and it was a tough lesson to learn. That's when I learned the importance of diversification firsthand. It wasn't just about spreading money around, it was about protecting my investments. I realized that spreading my investments across different asset classes was crucial for managing risk and achieving long-term success. Over the years, I've diversified into stocks, bonds, real estate, and even alternative investments. I've refined my diversification strategy, learning from each experience and adjusting my approach. And it served me well. Diversification has not only minimized my risks, but also maximized my returns. It's allowed me to weather market storms, stay calm during volatile times, and make informed decisions without panicking, and achieve my financial goals. Diversification has been the key to my financial stability and growth, and I can't stress its importance enough.
Section 9. Staying ahead of the curve. The importance of continuous learning. The investment landscape is constantly evolving. New asset classes emerge and market conditions change. That's why it's crucial to stay informed and continue learning throughout your investment journey. Read books, attend seminars, and follow financial news. Keep up with market trends, research different investment options, and understand how global events can impact your portfolio. Continuous learning will empower you to make informed investment decisions and adapt your diversification strategy as needed.
Section 10. Seeking expert advice. When to call in the pros. While diversification is a powerful strategy, managing your investments can be complex. Don't be afraid to seek professional advice. A financial advisor can help you create a personalized diversification plan based on your risk tolerance, investment goals, and time horizon. They can also provide guidance on asset allocation, portfolio rebalancing, and tax-efficient investing. Seeking expert advice can save you time, reduce stress, and potentially enhance your returns over the long run.
Section 11. Your path to financial well-being. Embrace diversification. Diversification is not about getting rich quick, it's about building a solid foundation for your financial future. By spreading your investments across different asset classes, you're reducing risk, enhancing potential returns, and positioning yourself for long-term success. Remember to determine your risk tolerance, choose your asset classes wisely, allocate your assets strategically, and diversify within those asset classes. Embrace diversification as an ongoing process and don't hesitate to seek expert advice when needed. Your financial well-being will thank you for it.